Silver is exploding higher, and the world is starting to notice. For years, it sat quietly beneath the surface of the financial system, underestimated, underpriced, and largely ignored by the mainstream narrative. But markets move in cycles, and when they turn, they do so with force. What we are witnessing right now is not just another routine rally. It is the kind of move that signals pressure building beneath the surface for a long time. It is the kind of move that makes people ask a serious question. Is this the last chance to get in under $100? To understand what is happening, we have to zoom out. Silver is not just a shiny metal. It is money. It has been money for thousands of years. It has survived empires, wars, collapses, inflations, deflations, and every financial experiment imaginable. It does not default. It does not go bankrupt. It does not rely on promises. It simply exists. And because it exists outside the credit system, it represents something rare in today's world. Final settlement. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now look at the environment we are in. Currency supply continues to expand. Governments continue to spend beyond their means. Debt levels globally are at historic extremes. Inflation data continues to surprise to the upside, even when expectations are already elevated. This is not a coincidence. When more currency units are created faster than goods and services, purchasing power erodes. That erosion is not always linear, and it is not always obvious at first, but eventually it manifests. And when it does, hard assets respond. Silver is reacting to that reality. It is reacting to inflation that refuses to cool in a meaningful way. It is reacting to money supply growth that continues to push to new highs. It is reacting to geopolitical instability that adds a layer of uncertainty to already fragile systems. Whenever tension rises in key regions of the world, capital seeks shelter. It seeks assets that are tangible, liquid, and globally recognized. Gold moves. Silver moves even faster. The velocity of silver's move right now is important. Silver is not just climbing, it is accelerating. That acceleration tells us something about positioning. For a long time, silver lagged. It traded far below its inflation-adjusted highs. It remained compressed under layers of resistance. But once those resistance levels begin to break, the dynamic shifts rapidly. Markets that have been capped for extended periods often release with explosive force. There's also the ratio between gold and silver to consider. Historically, the relationship between the two metals fluctuates in cycles. When the ratio is high, silver is undervalued relative to gold. When the ratio compresses, silver is outperforming. A rapid compression suggests that capital is rotating more aggressively into silver. It signals not just interest in safety, but interest in leverage to the safety trade. Silver historically amplifies gold's move. If gold climbs steadily, silver often surges. Then there is the structural side of the market. Silver is both a monetary metal and an industrial metal. It is used in electronics, solar panels, medical applications, defense technologies, and emerging energy systems. Industrial demand does not disappear simply because price rises. In fact, during certain phases of economic transition, industrial demand can remain robust, even as monetary demand accelerates. When both forces converge, supply becomes tight. Supply is not elastic. It cannot instantly respond to price. Mining projects take years to develop. Environmental regulations, geopolitical constraints, energy costs, and labor shortages all affect production. At the same time, much of the silver mined each year is consumed in industrial applications and not fully recycled. Unlike gold, which is often stored and accumulated, silver frequently gets dispersed into products. That structural difference matters when investment demand surges. Now layer in the financial system's mechanics. Futures markets, derivatives exposure, and leveraged positioning can suppress price temporarily. But when physical demand rises alongside financial demand, pressure builds. Any disruption, whether technical, structural, or liquidity-driven, can trigger rapid repricing. If confidence in paper representations of silver weakens, the scramble for physical supply intensifies. Recent trading activity suggests that stress may be emerging beneath the surface. Unusual volatility, sharp intraday moves, and rapid recoveries are signs of instability in positioning. Markets do not halt without reason. When technical disruptions coincide with key contract dates, it raises questions. And when price surges immediately afterward, it implies that whatever selling pressure was applied failed to contain the underlying demand. Think about resistance levels. Markets remember price zones. Traders anchor to them. When a metal repeatedly fails at a certain level, that level becomes psychological. But once it breaks, sentiment shifts dramatically. The move from doubt to belief can be swift. Silver pushing into the mid-90s is not just a number, it is a message. It signals that prior ceilings are no longer holding. And when ceilings break, air pockets above can create vertical acceleration. There's also the macroeconomic backdrop. Inflation coming in hotter than expected forces a difficult reality. If policymakers respond by tightening, they risk destabilizing debt markets and slowing growth. If they do not respond aggressively, inflation expectations can become embedded. Either path carries risk. Hard assets thrive in environments of uncertainty and declining real purchasing power. Silver does not require perfection. It requires instability. Money supply hitting new highs while inflation surprises upward is not subtle. It is textbook. More currency units chasing limited goods result in price pressure. Over time, people adjust behavior. They seek assets that cannot be printed. They seek stores of value that are not liabilities of someone else. Silver fits that definition. Geopolitical tension adds fuel. When travel advisories escalate and regions become unstable, markets react instantly. Oil moves, currencies move, metals move. Fear is a powerful accelerant. Even the possibility of escalation can shift positioning dramatically over a weekend. Traders do not like uncertainty when markets are closed. That gap risk often drives preemptive buying. The question becomes timing. Is under $100 a fleeting window? Markets do not announce final opportunities politely. They move when positioning is wrong. They move when complacency is high. They move when narratives shift. If silver establishes itself above $100 decisively, that level may transform from resistance into support. And once a triple-digit price becomes normalized, psychology changes permanently. Consider historical precedent. When silver has broken into new territory in the past, it has not done so gently. It has spiked. It has corrected violently. It has spiked again. Volatility is part of its character. Those waiting for perfect pullbacks often find themselves chasing higher prices. Momentum can feed on itself, especially when technical breakouts align with macro catalysts. There is also the market capitalization perspective. Silver remains small relative to many financial assets. It does not require massive capital inflows to move dramatically. Even a modest reallocation from institutional portfolios can have outsized effects. If silver begins to be viewed not just as a commodity, but as a strategic monetary hedge, flows could increase significantly. The mining ratio between gold and silver adds another layer. If only several ounces of silver are mined for each ounce of gold, yet the price ratio remains dramatically wider, there's an argument for compression. Markets are not perfectly rational in the short term, but over long cycles, they often gravitate toward structural realities. If gold continues to push higher and silver closes the ratio gap, triple-digit silver becomes less speculative and more mathematical. Average annual pricing crossing symbolic thresholds also matters. When averages rise above major psychological levels, it signals sustained strength rather than a temporary spike. An average above $100 would imply not just a momentary surge, but an embedded revaluation. That would shift long-term perception. Another factor is public awareness. For years, silver has been overshadowed, but explosive price action attracts attention. Attention brings new buyers. New buyers create momentum. Momentum attracts media coverage. Coverage feeds narrative. Narrative drives flows. Markets are reflexive. But beneath the excitement lies a deeper theme: trust. Trust in institutions, trust in currencies, trust in debt markets, trust in the stability of the global order. When trust erodes, tangible assets rise. Silver's rally may be signaling not just inflation fear, but broader skepticism. Energy markets remain volatile. Supply chains are fragile. Global alliances are shifting. Currency blocks are experimenting with alternatives. These structural changes do not resolve overnight. They create an environment where diversification away from pure financial assets becomes rational. Physical demand is another key piece. When investors shift from paper exposure to physical accumulation, available supply tightens quickly. Premiums rise, inventories draw down, delivery times extend. These signs often appear before price makes its largest moves. If that dynamic is beginning to unfold, the repricing could accelerate. The idea of last chance is powerful because it captures urgency. But urgency should be grounded in analysis, not emotion. The analysis suggests that silver is positioned at a critical juncture. Breakout levels are being tested, macro conditions are supportive, structural supply constraints exist, geopolitical risk is elevated, monetary expansion continues. All ingredients are present. Markets can pull back. Volatility guarantees that. But when a long-term base resolves upward, corrections often become buying opportunities rather than trend reversals. If silver establishes a new trading range above prior ceilings, dips may become shallow and short-lived. There's also the psychological barrier of 3 digits. Humans anchor to round numbers. Breaking $100 is not just arithmetic, it is symbolic. It reclassifies the asset in the public mind. It forces reevaluation. Once that barrier falls, discussions shift from if to how high. Consider also the real return environment. If inflation runs hotter than nominal yields, real rates compress. Negative or low real rates historically support precious metals. If bond markets struggle under the weight of debt issuance and inflation expectations, capital may seek alternatives. In every major monetary transition in history, hard assets played a role. They acted as anchors when paper systems strained. We may not be in a full transition yet, but stress indicators are visible. Silver's surge could be an early warning. This is not about hype. It is about probabilities. When multiple independent factors align in the same direction, the probability of continuation increases. Inflation surprises, money supply expansion, geopolitical instability, technical breakouts, ratio compression, structural supply constraints, rising averages, growing awareness. Each factor alone may not guarantee triple-digit silver. Together, they form a compelling case. If momentum continues into next week, and if external risks escalate over a weekend, markets could open sharply higher. Gap moves are not uncommon in commodities during times of tension. Once above $100, short covering could amplify the surge. Traders positioned against the move would be forced to adjust quickly. At the same time, risk management remains critical. Volatility cuts both ways. Those entering the market must understand silver's nature. It can move 5% in a day. It can retrace violently. It rewards conviction, but punishes over leverage. The broader message, however, is clear. Silver is no longer asleep. It is awake. It is responding to forces that have been building for years. Whether under $100 is truly the last chance cannot be known with certainty. But the window appears to be narrowing. We stand at a crossroads. A metal that has been undervalued for decades is reclaiming attention. A financial system stretched by debt and expansion is facing inflationary pressure. Geopolitical tensions are rising. Confidence is being tested. In such moments, markets reprice reality. Silver's explosion higher may be just the beginning of that repricing. When a market transitions from quiet accumulation to aggressive markup, the shift is rarely subtle. It feels sudden, but in reality, it is the release of pressure that has been building for years. Silver's surge toward and potentially through $100 is not an isolated event. It is the visible symptom of deeper fractures inside the monetary and financial structure. For decades, the global system has relied on confidence in expanding credit. Debt has grown faster than productivity. Asset prices have been supported by liquidity injections, rate suppression, and repeated interventions during times of stress. Each cycle required more stimulus than the last. Each rescue demanded larger balance sheets, greater currency creation, and more aggressive policy responses. That accumulation of excess does not disappear quietly, it compounds. Silver is extremely sensitive to that compounding. Unlike many financial assets, silver is not someone else's liability. It carries no counterparty risk. It does not depend on earnings reports, refinancing windows, or political approval. It simply reflects purchasing power. When confidence and purchasing power weakens, silver adjusts upward. What makes this moment different is the scale of imbalance. Currency supply has expanded dramatically over the past decade, and especially in the most recent crisis cycles. Even when growth slows, the base remains permanently higher. Inflation does not need to rage out of control to support higher silver prices. It only needs to persist above comfort levels long enough for expectations to shift. Expectations are everything. If businesses expect higher input costs, they raise prices. If workers expect higher living expenses, they demand higher wages. If investors expect currency dilution, they seek protection. That self-reinforcing loop embeds inflation psychology into the system. Once embedded, reversing it becomes extremely difficult without triggering recession or financial stress. Silver thrives in that tension. There's also the issue of real yields. When nominal interest rates fail to keep pace with inflation, savers effectively lose purchasing power by holding cash or fixed income instruments. That silent erosion drives capital into alternatives. Historically, periods of suppressed or negative real rates align with powerful precious metals bull markets. But silver's case goes beyond monetary hedging. Industrial demand continues to expand structurally. Renewable energy infrastructure requires significant silver inputs. Advanced electronics depend on silver's conductivity. Defense technologies rely on it. Medical applications incorporate it. These uses are not speculative. They are embedded in modern civilization. At the same time, supply growth remains constrained. Major new discoveries are rare. Mining projects face environmental, regulatory, and geopolitical challenges. Energy costs impact production economics. Many silver deposits are byproducts of other mining operations, meaning silver output is partially dependent on the economics of entirely different metals. That creates rigidity in supply response. So when investment demand rises on top of steady industrial consumption, the balance tightens quickly. This tightening often first appears in subtle ways. Inventory drawdowns, higher premiums for physical delivery, increased lease rates, backwardation signals. Then price follows. Financial markets sometimes mask this pressure through derivative expansion. Paper claims can multiply far beyond available physical inventory. As long as confidence remains intact and most participants settle in cash rather than delivery, the system functions. But if confidence wavers and delivery demand rises, stress becomes visible. Technical disruptions in trading environments, especially near key settlement or notice dates, amplify scrutiny. Whether caused by genuine technical faults or overwhelmed infrastructure, interruptions undermine trust. Markets rely on seamless execution. Any disruption invites questions about underlying strain. And when price surges immediately after such disruptions, it suggests that suppression attempts, intentional or not, fail to alter the broader trajectory. Momentum matters. Silver is historically volatile. When it moves, it tends to overshoot. Short positions can unwind violently. Leveraged traders can be forced to cover. Algorithmic systems amplify breakouts. Each layer of participation compounds the move. If silver pushes decisively beyond $100, a cascade effect becomes possible. Psychological resistance turns into support. Institutional models recalibrate. Risk managers reassess exposure. Retail participants experience fear of missing out. Media narratives shift from skepticism to fascination. That transition phase can be rapid. Consider what triple-digit silver represents symbolically. It redefines value perception. It signals that the metal is no longer trading in the shadow of its past highs. It communicates that the monetary environment has changed meaningfully. It forces portfolio managers to reconsider allocation strategies. Market capitalization comparisons also become relevant. Silver's total valuation remains small relative to global equities, bonds, and even certain individual corporations. It does not require massive capital rotation to drive substantial price appreciation. Even incremental institutional interest could exert outsized influence. There's also the gold-silver dynamic. Historically, during early phases of precious metals, bull markets, gold leads as the primary safe haven. As confidence builds and momentum strengthens, silver begins to outperform. Ratio compression becomes a defining characteristic of the later stages of strong cycles. If that compression continues aggressively, triple-digit silver could be a midpoint rather than a peak. We must also address currency competition. Around the world, nations are exploring alternative trade settlement mechanisms. Commodity-backed arrangements, bilateral agreements, and regional currency blocks are emerging. While these experiments may take years to mature, they reflect dissatisfaction with existing structures. Precious metals historically play a stabilizing role in such transitions. Whenever confidence in fiat frameworks weakens, tangible reserves gain relevance. Another factor is generational psychology. Younger investors who experienced currency debasement, asset inflation, and systemic crises early in life often develop skepticism toward traditional financial assurances. Digital platforms accelerate information flow. Narratives around hard assets spread quickly. Social sentiment can shift in days, not years. If silver captures that attention at a moment of macro stress, inflows could surprise to the upside. Volatility will remain high. Silver rarely moves in straight lines. Sharp corrections are part of its character. Pullbacks of 10% or more can occur within strong uptrends. Those corrections test conviction, they shake out weak hands, but in structural bull markets, they often resolve higher. The key question is sustainability. Are the drivers temporary headlines or structural forces? Inflation persistence appears structural. Debt saturation appears structural. Monetary expansion appears structural. Industrial demand growth appears structural. Geopolitical fragmentation appears structural. When multiple structural drivers align, trends extend. It is also worth examining the behavioral component of last chance thinking. Markets punish complacency. For years, silver traded below levels that many believed undervalued relative to monetary expansion. Those who accumulated quietly during that period positioned themselves ahead of the breakout. Now, momentum is visible. Urgency replaces apathy, yet discipline remains essential. Allocation should reflect risk tolerance. Leverage should be approached cautiously. Physical ownership differs from speculative trading. Each participant must understand their objective: wealth preservation, capital appreciation, or short-term speculation. But from a macro perspective, silver's repricing appears logical rather than irrational. If inflation remains elevated and currency supply continues expanding, purchasing power will continue eroding. Hard assets historically adjust upward to compensate. The question becomes not whether silver should be higher, but how rapidly it will reprice. History offers lessons. Parabolic moves often occur near the end of long consolidation phases. They can double or triple within months. They can overshoot fair value dramatically. And once momentum peaks, they can retrace sharply before stabilizing at much higher plateaus than where they began. If silver accelerates beyond $100 quickly, volatility could intensify. Price discovery in new territory is rarely smooth, but once the market establishes equilibrium at higher levels, the narrative shifts permanently. Another important consideration is global participation. Silver is recognized worldwide. It trades across continents. Demand is not confined to a single economy. In times of regional stress, global liquidity flows toward universally accepted stores of value. Silver benefits from that universality. Meanwhile, production cannot scale overnight. Even if prices incentivize expansion, mining timelines are measured in years. Environmental permitting, infrastructure development, capital expenditure, and political negotiation all introduce delays. That lag between price signal and supply response can prolong bull cycles. Speculative interest may also expand through exchange-traded vehicles and digital platforms. As accessibility increases, participation broadens. Each new participant adds incremental demand. And then there is the simple mathematics of ratio compression. If gold continues higher while the ratio narrows toward historical averages, silver's upside multiplies. For example, modest gold appreciation combined with ratio normalization could push silver far beyond triple digits. That scenario is not guaranteed, but it is plausible under current macro conditions. We must also consider confidence shocks. Financial markets are interconnected. Stress in one asset class can spill over rapidly. Credit events, sovereign debt concerns, banking instability, or geopolitical escalations can catalyze safe haven flows. Silver, due to its smaller market size, often reacts disproportionately. The system today carries elevated leverage across multiple sectors. Derivatives exposure remains substantial. Debt rollover requirements are constant. In such an environment, unexpected shocks can accelerate capital migration into tangible assets. Silver's recent surge may represent early positioning ahead of broader turbulence. Another overlooked element is cultural memory. Precious metals have deep historical roots in wealth preservation. In times of uncertainty, that memory resurfaces. Even in modern digital economies, physical assets retain psychological power. They are tangible anchors in abstract systems. As triple-digit silver approaches, the conversation shifts from theoretical to tangible. Investors who dismiss the possibility must reconsider. Institutions that ignored allocation models must reevaluate risk parameters. Media coverage amplifies awareness. Awareness attracts participation, and participation fuels momentum. However, sustainability ultimately depends on macro continuity. If inflation cools dramatically, real yields rise meaningfully, geopolitical tensions ease, and currency expansion slows, silver could consolidate. But the probability of all those conditions aligning simultaneously appears low given current structural realities. Thus, the base case leans toward continued volatility with upward bias. The concept of under 100 may soon feel nostalgic. Psychological ceilings, once broken, rarely regain dominance. Markets adapt quickly. What once seemed extreme becomes normal. But whether silver pauses at $110, $130, or accelerates beyond depends on flows, sentiment, and macro catalysts. The foundation appears strong, the triggers are visible, the environment is supportive. Silver is not merely rising because traders are enthusiastic. It is rising because confidence in paper frameworks is thinning. It is rising because supply cannot instantly expand. It is rising because industrial demand persists. It is rising because money creation continues. It is rising because geopolitical risk remains elevated. These forces do not vanish overnight. If the breakout holds, the repricing phase could extend for months or years. Corrections will occur, headlines will fluctuate, sentiment will swing. But structural bull markets are defined by higher highs and higher lows. Triple-digit silver may not mark the end of the move. It may mark the beginning of broader recognition. The market is signaling that something fundamental is shifting. And when markets speak with this kind of velocity, it is wise to listen. Silver's explosion higher is not just a price story, it is a signal about inflation, about currency dilution, about geopolitical instability, and about confidence in the financial system itself. Whether under $100 truly represents the last opportunity cannot be known with certainty. But what is clear is that the forces driving this move are larger than a single trading day. If those forces persist, triple-digit silver may soon feel less like a milestone and more like a stepping stone in a much bigger monetary transformation.